Hi, my name is Asher Paris, and welcome to my screencast assignment on financial statements, and in particular, focusing on the balance sheet. A balance sheet is a financial statement that takes a snapshot of a business's assets, liabilities, and equity at any given point in time, and at the end, the two sides should equally balance. You may recognize these terms from the accounting equation. On a balance sheet, we group together these total assets, liabilities, and equities into current and non-current subcategories of their own. The balance sheet reaches a state of equilibrium in which assets equal liabilities plus equity, the blueprint of the balance sheet. Current assets are any assets that are expected to be consumed or converted into cash within a year, and are listed on the balance sheet in order of their liquidity. Common examples include cash. Non-current assets are those that are used in a business processes for more than 1 year. Examples of non-current assets include property and equipment such as trucks. Liabilities are the obligations of a business and are also classified into current and non-current categories. Current liabilities are expected to be satisfied within 1 year, and examples include accounts payable and salaries owed to employees. A non-current liability is an obligation that cannot be satisfied within 1 year, and examples include bank loans and mortgages on properties. Equity is the difference between a company's assets and its liabilities, and is generated from a business's retained earnings or contributed equity. Retained earnings is the amount of equity a company generates from being profitable and keeping their profits within the business. It is retained in the company and acts as an indication of share profits to investors. Contributed equity illustrates the amount of equity a company generates through a sale of shares to investors, and are written up to keep investors and CEOs happy and out of the boardroom. Here is a worked example. Imagine you need to buy a computer for your new business. The cash in your assets decreases, but the new computer helps balance this out in the assets section. As you sell to customers, your profits are recorded into retained earnings in the balance sheet. And finally, the cash from these profits are recorded in the assets section, and the sheet remains balanced. Once again, here is a basic formula which you'll need to follow in order for your statement to remain balanced at any given point in time. No, please don't mention it. Thanks a lot. It was nothing. Cheers!